Welcome, everybody. Thank you for joining us today. We are broadcasting live from Park City, Utah, where I am, and you're in Austin. Thank you for joining us today. This is a Luminary series, which means we're going to talk to Andrew about all the interesting things that he's doing and has done as it relates to his VC fund. And I think you're going to enjoy the conversation. We can't see or hear you. We know you're there. Even though we can't hear or see you, we strongly encourage you to ask the questions as they come to mind and post them in the Q&A or the chat box. And we'll, as we have a lot of people coming on today, we'll get to as many as possible. But please feel free to go ahead and ask your questions in the chat box in the Q&A. The other thing that you should know is that we're going to record this and post it on the Family Office YouTube channel. So with that, thank you all for being here today. Super appreciate you spending your time with us. And Andrew, welcome. Take it away.
Thank you. Hey, Arthur, great to see you. I think the topic we thought would be fun to get into is recession is on everyone's mind, and we're starting to see property prices come down and interest rates go up, and kind of what does that mean for startups? What does that mean for VCs? And what does that mean for LPs? So should we dive into that topic?
Let's do it. Yeah.
Yes.
By the way, somehow we disabled the chat. It should be okay now. Thanks, Jack, for telling us.
The first thing that happens when you see multiples in the publicly traded equities world of what's the multiple of Zoom trading at, what is Salesforce trading at? And I think the natural state of the world in the tech world is probably like a 12x, so price to sales, and these guys have decent growth, they're innovative, they're stocks you want to own. And in the privately held world, we're somewhat mirroring that. So we're investing in a company, there's a multiple of sales, the growth is probably way higher. In a discounted cash flow, it's top line, bottom line, G for growth. You play with that G and it has a big impact. And funny enough, if you increase the WACC, the cost of capital or the interest rate on discounting cash flows from the future to today, the interest rates going up will make that market cap a lot lower. If you remember your MBA or going to finance.
Yeah, the net present future. Yeah, the discount calculation, right?
Yeah. So when interest rates go up, theoretically, all those things should get smaller, and there should be deflation of valuations in the private markets. But here's what always happens is that the stock market has a crash, and we've just seen the stock market go down for all of us, that there's typically a lag, but you expect valuations of the startups to come down. And if the anticipation was that we're going to sell this startup to Microsoft, Google, Apple, Amazon, and they've all had a decrease in valuation, you can be damn sure that this valuation should come down also. I found as a VC that the very experienced VCs know this, and valuations will come down in almost real time alongside that publicly traded market, public equities. But a lot of the early, newer VCs that have never even lived through a downturn are saying, who cares about that? Thank God I'm over here. And they continue to fund companies, and companies continue to raise capital. But there's a couple of sort of empirical, non-debatable things that happen. Valuations of startups come down, and they have come down. I think that 2021 the summer was, in my view, the peak. And a bunch of our companies raised money and got in $100 million rounds when we were in super early. And by October, you saw valuations come down for the sophisticated kind of inside Silicon Valley deals. There might have been some seed stage angels or new VCs that were continuing to invest at high valuations. But by October, it had pretty well corrected. Then we had a stock market drop and a crypto drop, and that really brought the valuations down. So what does that mean? That means that the company that was going to raise money at a $120 million valuation is now raising at a 32 valuation. And it's a big correction that might look bigger than the correction in the stock market, but here's why. What happens in the total bull go market, people say, all right, if the unit economics of the startup are working, that if we put $1,000, if we spend $1,000 to get a real estate agent to come over to our digital platform, and we have monthly of this, and if they close 2 deals a year, and if it goes on for 3 years, we're making 18 grand. So they basically say, if I drop $1,000 into the sausage machine, it gives me 18,000 at the bottom. And in the go-go market, they say, how much do you need to raise? What are your capital requirements to carry this company 2 years and keep growing? And the answer is probably 5 million. And then the VCs like Andreessen say, well, I have a big fund. Let's make it 25 million. So the company goes and raises 25 million, and they're only selling 20% of the share capital. So what does that mean? The valuation is like 100 million plus. Then the stock market crashes. I literally say, thank God the stock market has crashed. And the company says, I think we should raise 7 million. And we're still only selling 20% of the share capital. And that's where you see the constant point is that they're only selling 20%, whether it was a 25 million round or a 5 million round. And then all of a sudden people say, look, let's not overfund this thing. And so valuations come down. Now, as a VC, we're not day traders, sadly. We're kind of patient guys that are going to hold that company for a couple of years before we get to an exit. And exits typically are, you can get lucky, but we don't plan on getting lucky. We're looking at kind of 3-year, 5-year, 7, 8, even sometimes 9-year time horizons. And I want to talk about on this session, if we can, how to return the fund faster through secondary markets. But basically, if your entry point came down and the economy has recovered by the time we exit, then this is a good thing that there's been a crash of the stock market and there's fear of an economic downturn. Another big thing that, go ahead, Arthur,
hang on one second. Hang on one second. Just only because I think it's worth pointing out or clarifying. So the valuation from 120 to 30 is pretty dramatic. And the constant that you're suggesting is they're still only selling 20% of the company because they're going to raise 7 instead of 35 or whatever the math might be, right? Wouldn't it also be true that if they can spend, are they spending 1,000 and getting 18 in either one of those environments?
Yeah, if anything, so spending 1,000, and this is the true story. I invested in a company called Radius Agent, and Tim Galleri was on the advisory board of my previous company, the Founders Club. So I know everybody really well. Tim's been trying to get me into Radius for a long time, and it's everything I love. It's real estate. It's digitizing everything. It's like DocuSign for real estate. And their CAC, their cost of acquiring a customer, is 1,000, and it's like 1.3. And then their LTV, lifetime value, is 18,000, and I think it could be much bigger. And their payback is between 3 months. It can be under if the real estate agent closes a deal, but it's minimum 3 months. They get all their money back. So that generally should remain constant. But typically, when you dump a load of money like a stork flying overhead onto a startup, and they start spending a $25 million financing round, they're not going to be as efficient of spending 1,000 to get one. Like if I just put in a little bit out there, I'm catching a fish. If I throw a hook with 1 million baits into the same pond, I might not catch linearly more fish.
Same ratio, yeah.
Yeah, so basically you expect CAC to go up. You expect the cost of acquiring a customer to go up when you try to scale. And you can talk yourself into why we're going to get economies of scale and CAC will come down. And every good presentation is showing you how CAC will go down and average contract value will go up. And so the margins on this are getting better and better. But yeah, that sometimes the round is not selling 20%, they're selling 1/3. But in general, if the size of the round came down, then it means the valuation will come down. and you expect the market to have recovered a few years later when we sell. And so this vintage should perform much better. The total cash on cash return the LP gets is bigger. My income should be bigger. And there's reasons why that startup is at lower risk of failure. Another thing that we can all empirically agree on is that if they have 5 million or say 7 million they're versus 25, they're going to make that last 24 months. So if they've got an operating budget of what are my monthly expenses, what is my monthly revenue, what is my monthly burn rate, or how much am I generating? These are usually running at break even. And if you have access to the VC machine, they're loss making. So they're burning money for growth with the ability to tip into profitability one day, or if they have to. So if you've got 7 million, they're going to come up with an operating plan in an Excel spreadsheet that says, I can make this money last 24 months. So in a year from now, I can go back on the road, show all the VCs our numbers, and raise the next funding round while I still have a cushion of 12 months cash in the bank. Some people will sail a little closer into the wind and push those numbers. And when they have 6 months cash in the bank, hope to close a round of the next funding round at a higher valuation. They don't want to sell too much stock while it's cheap. If I can put this money to work, buy more customers, pay engineers to tap into more data sets that increases the value to a customer, I can grow revenue with my existing customers, I can buy some new customers, and I can raise money at a higher valuation. Go ahead.
No, later on. By definition, that scenario would suggest that you're slowing growth, but being more efficient with the capital, so you can demonstrate that you can spend money better as a company. And so when you go to the other round, your numbers look better.
That's right. And I'll tell you that, but there's a whole bunch of implications to reality. If you had a startup in San Francisco or Austin or New York or anywhere that's a hot market, and your employee goes out for a falafel for lunch, and he walks down the street and sees some chalkboard that doesn't say soup of the day. It says, we just raised 75 million from Kleiner Perkins. We're offering dental care for your dog. Come on in and learn about joining our team. That there's, if the company is raising 7 million instead of 25 million, they're going to hire fewer people. And the other thing that happens is the big tech titans, like you're seeing it now. And my article I put on this on LinkedIn was dated in June, and you're seeing it happen now. Facebook, Google, VMware, Cisco, Amazon, Microsoft put a freeze on hiring, and they start firing all the dead weight that they wanted to fire.
Anyway, yeah. They just weren't in a position to do it and not get sued or have a big exit package or something like that, right?
Yeah, I've had to fire people that are like triple protected, minority. I've got an extra 2 lawyers in the room when we fire someone that was an axe murderer. We just got rid of Jeffrey Dahmer, right? And whereas now, the stock market has crashed, I'm going to get my gun out and get rid of that person right away. Yeah. I mean, like, she's better off somewhere else than working here because we think she's nuts. Yeah. So you see a lot of people are losing their jobs, or they're not offering massage and an Uber ride home. You see startups offering Uber rides home for every employee in New York every night. And there's a Michelin star restaurant serving the Royal Younglings in San Francisco with Michelin star sandwiches in the office. Yeah. You start to
get an omakase budget. Right.
So the term austerity will be introduced to the new, Gen Z VC, that the talent war starts to get a little under control. And so if there's more talent available, that it's easier to build a great startup without throwing insane amounts of money around, to get them in there. And I would say that execution is everything, and execution is about the people and the talent. And this is almost all about talent, and not prematurely hiring and Why do we need a head of international biz dev for Asia if the product hasn't been released yet? That's a stupid premature spending. So,
Yeah.
so that's good. Another big thing we see when this happens, and thank God it's happened, is that in the crazy boom times, some CEOs are not even willing to go through due diligence. So I'm not going to invest in a company. We're not going to invest in a company without understanding if the revenue was license reoccurring or if it was a
Consulting.
one-off.
Yeah.
Yeah, like we're going to figure this out before we accidentally invest. We're not going to invest out of pure passion and then later find out that you were showing revenue from your old accounting services business. We thought we invested in an automation software accounting and you haven't pivoted yet. When we start to do our Columbo investigations, some CEOs in the peak were saying, I don't think this is a cultural fit. You appear to be doing due diligence here.
Yeah.
This round will be done by Friday and it's Wednesday. Are you in or out?
Yeah.
And we were just never doing that. Whereas now that same CEO says, hey, do you still want to understand our revenues and our customer mix and our product mix and understand this business? I'm ready to do due diligence again.
Like
where
the
I
great
wasn't.
cleansing, right?
Yeah, exactly. And so so valuations come down, the talent is available. The large tech companies say, let's get back to our knitting. And so doing video on demand projects when we were Google doing AdSense is no longer core. Let's get back to our core knitting a bit. Frankly, the large corporates are a little less competitive to some of the innovation that's actually happening. And they want to be funding the core business or the core adjacent business to some extent. And the guy that was running video on demand at that company that was non-core says, I still have customers that want what we're building. Why don't I get a golden parachute, leave Google, raise some venture funding and start a new company at a time when valuations were low, when the talent was available, austerity is kicking in, DD, rational things are happening. The company raised their next round after getting through milestones. You achieve a milestone, a new gate opens up. You raise money, you achieve a milestone, a new gate opens up. Nobody rational would fund a biotech company for phase 1, phase 2, phase 3, and the battle with the FDA before we found out if it doesn't work on rats or prisoners or it doesn't kill you and your body parts don't fall off.
Yeah.
So, and we don't do biotech, but we believe in milestone financing. So there's a total return to sanity.
What do you think? This is not a very good representation in terms of data points, and I admit that I'm not dialed into the hiring thing because I try to stay away from that, but because I'm not very good at it. But I have seen just anecdotally in my LinkedIn or otherwise, hey, I lost my job, I got fired, and now I'm available. Whereas 6 months ago, that wasn't even happening. Are you seeing that are you seeing that to the extent that my anecdotal experience suggests that it's about to open up and people are going to be, fired and dying to work?
Well, I think that there's also another thing that happens here is that it's harder to raise capital. So it's harder for VCs to even raise capital. There's a little less VC funding to go around. Deals take longer to close. People are banking on 24 months runway, not 18 months runway before they run out of money, or even trying to play it even closer to the wind. So you do see there's fewer employers from the large companies and the startups trying to hire the people that we know in our industry. So someone's going to be let go, or the new funding round didn't come through. They're getting let go, even across the board. But I don't feel so bad about letting someone go when we have to do it to save the ship. It's like we could let the Titanic sink to the bottom of the ocean with every man, woman, and child in it. Or if the young CEO is having difficulty firing people, it's really hard work, and we'll come in like Harvey Keitel, ready to mop up blood and brains and just get it done. and go out and cry and have a drink afterwards. But those people should be the most marketable people in the world that are getting fired. It wasn't that they got fired because they suck at their job.
It just wasn't funding, right?
It's just that the number one cause of death for a startup is running out of cash, and you get it from customers, VCs, or changing what you have control of, your spend. And I've seen many companies just slam into a wall, like they didn't know that they were going right into a wall. So
it's all well and good to be thoughtful about your employees and their families and all that kind of stuff, but I don't know. I have a very prejudiced view on this, is that if you want me to keep you so you can be okay, but in 6 months we're all done, what good is that?
Right. That's sinking every man, woman, and child to the bottom of the ocean. So if your goal was to preserve life, killing everybody was not a great move. Let's just nuke the whole place while we're at it and drink some literal Kool-Aid. So, but I do think that we all have reputations. There is the right thing to do when you're letting someone go. The more advance notice, the more cash and walking money you can give them, the better. And even the more introductions you can give them, the better. And people will remember that when you fired someone, you made 100 introductions and did everything you could to help them land in a good place. And then they're going to be easier to hire back when you want to. You may end up funding that other company. So like I openly have this on my LinkedIn like about me section. I think I start with saying, if you spend 30% of your time doing favors for other people without asking for anything in return, your remaining 70% of your time will probably have a 2x multiplier and how much
productivity,
how much results you're driving. So that's like a 1.4x increase in performance while being a good person, collecting a lot of good karma points. But so I think that's an important thing. I used to hire people for my own startups and say, we're not Goldman Sachs. We can't have 120 interviews per person, triangulating on everybody. We're going to give you a job, and if it doesn't work out within the first 3 months, we'll let you know.
Pilot program, right?
I mean, and because we were growing too fast to really, run it any other way.
I love the Pulp Fiction reference, by the way. Thank you for that. Good. Yeah.
Well, it's not, a lot of this job is hard. I mean, that's like the worst part of the job, probably. I once went in and helped a guy save his company by firing like a third of the company, and then the next day he hired them all back. And I was like,
couldn't take it. You couldn't take it. Yeah. Wow.
It's a hard one.
Yeah. So let's talk a little bit more about some of the stuff that you've learned and executed on in investing as a VC that probably others don't know about.
Well, I mean, my own life story had certain things happen to me that it was hard to not embed this into our strategy. So it's not like I'm a genius, but we're doing some things that others are not doing. For example, I was worth 300 million on paper as a founder, went into an IPO, and then the Department of Justice announced they were breaking up the monopoly of Microsoft of the operating system to Windows. And that was the pin that burst the bubble for Morgan Stanley, who is our lead underwriter for our $1.2 billion IPO. And, I kind of thought, gee, it wouldn't have been nice if I could have sold maybe 10% of my 300 million, hung out a bit more with you, Arthur, and figured out how to balloon that up to 90 and a little better. And had I been investing, into all my founders that I knew back then, life might look even, better now than it does now. And so I kind of thought selling a little bit early makes sense. In my first book, I have a chapter on M&A, which is one of my favorite chapters. And the quote I start with was, "I made most of my money selling too early, JP Morgan."
Yeah, right.
And there is some serious wisdom in that quote, right?
Yeah.
And so one thing that we're doing is, and then the second thing is I founded this thing called the Founders Club, where anybody who raised 5 million off our kind of tier 1 Ivy League list of VCs would get an email from one of our interns from the Founders Club saying, how would you like to swap some of your founder shares for a limited partnership interest that pools together shares from 25 venture-backed startups, and then we all go out to dinner and get to know each other and help each other. And so that was the Founders Club. It's a venture capital equity exchange fund. And secondaries were taboo back then. For the founder to sell her stock before the IPO,
The optics was too harsh, right? Yeah.
Exactly. It was considered a negative signal that would drag us all down. But, that's kind of BS, because this founder can't pay herself more than X amount of dollars. She lives in New York or San Francisco. There's kids. They still don't know how to ski. All her MBA buddies have their houses in Tahoe. She can't even afford the lift ticket. And yet she's worth Austin Powers 300 million on paper.
Yeah.
And the VCs are not suffering. They're in Tahoe. Come on.
Yeah.
So I sort of thought, let them exchange equity with each other so they benefit from every exit in there. And it makes a fight club of founders. But we started to see Daniel Elk. We knew him at his previous company, Stardoll, before he founded Spotify. His angels were actually investors in the Founders Club. I had done work for Crandom and Northzone as VCs. He tells his VCs that are friends of mine, I'm putting 20 million euros into Andrew's Founders Club and getting equity in a bunch of other companies. And they said, no, we'll buy it for cash. Just give us 3-4 weeks, maybe give us 2 months.
Yeah, let me think about that, right?
Yeah, we'll spin up an SPV with a subset of our LPs.
Yeah.
Hey, this is an asset you want to own, Spotify. Who wants it? And so we lost Daniel there, and I said, we're dead. And so I started brokering secondaries, helping founders sell shares in their late stage growth companies. And I had I had the distinct torture hell of being under FINRA and having him read all my emails and taking those tests and all that, and being in a broker dealer. But I'm happy because as fintech investor, I like to now know all that stuff I learned about the law with FINRA and the SEC, going through that experience, but also secondary. So to tie it together with what we do now what we think is that if the founders are selling secondaries, are they in a rush to IPO the company or take the first M&A offer that comes by? VCs have big funds. If they don't get a $1 billion exit and they don't own 25%, their whole $1 billion fund starts to fall apart. They need 4 deals to sell at $1 billion, where they own 25% at that moment, and that pays back their $1 billion, or else they're not going to keep 2xing their funds. Or
meanwhile, they flushed, 70% of the companies, right?
Sorry?
Meanwhile, they flushed 70% of the other companies.
Yeah, well, they're pushing the founder, they're putting like all kinds of propane into the gas tank to make that founder run as fast as possible. And the motor's going to explode on some of them, but one of them will get to the finish line and get what they want. And they're diversified. And I still have this founder perspective that I had as a founder and the Founders Club of protect founders and diversify them. But here's the bottom line is that VCs are promising to pay back the LP within 1 to 3, 4, 5 years. They're kind of lying to themselves and they're lying to you. If anything, the time delay between Series A or late seed or seed to IPO and survive a lockup, that's a long time.
Yeah.
That, M&A, it's a long time. And now all of my IPOs are on hold right now. So we've come to the conclusion, we invest in mostly late seed and Series A. We'll fund someone like Daniel that we knew from his last company at absolute first money in. And we know it's a long way to go for the exit, but that person's not going to struggle. Like Jack Dorsey's not going to struggle to raise money for his seed round, his A round or B. So if running out of money is the number one cause of death, we could take some risk, and we're distributed, we're diversified. But the key thing is, what about selling a small percentage of what the fund owns in 1 to 7 of our portfolio companies when they're raising at $1 billion valuations and staying private forever? So we've always thought, invest in like 1/3 of our cash pre-Series A, and then 70% trying to focus on the A round with a little bit of B, when there's still upside to make a 20, 30, 50x return on that investment. By the time you get to B plus, Series C, Series D, pre-IPO, like we were talking about this a moment ago, if someone says, oh, I want to buy some Spotify shares before the IPO, No one cares about your network of who you know in Japan. The ship has sailed. Who's dumb enough to pay 1 basis point higher on whoever the seller is on what is essentially a publicly traded company, but still has not IPO'd? So our thought is just do SPVs from our LPs for all the growth rounds. Some of our LPs might say, well, it looks if companies raising 100 million round, they're going to buy more salespeople and engineers. It'll probably 2x in a year. Or if it doesn't sell for 2 or 3 years, it'll maybe 5x at the most. That would drag down the performance of our fund. So we're doing SPVs with our LPs all the way up to exit if we still think it's a good investment.
So let's talk about the mechanics of that.
Yeah.
So slicing off a piece of 4 to 7 of the companies, who are the buyers of that liquidity?
We are. So what we do is in the past, we would just invest from the fund. And then when we see the multiple getting below 10, we say we want to 10x plus the whole fund, net of losses and fees. We're only going to invest as SPVs. All right. So we communicate a lot with our LPs. They're learning, we're learning from them, and we fund our companies via SPV only. Now we're saying, let's continue to invest at the price of the transaction. So some large growth investor is pricing the round and it's happening. And we're investing alongside that same price and terms. But instead of wiring all the money to the company, we're saying, do any of you guys want to sell and get a little cash in your pocket sooner? A lot of LPs in our fund are literally friends of mine from the Founders Club. Like the founder of Yap, which sold to Amazon, which became Alexa. He's an LP. He's a civilian, normal person. He might have made like 50, 80 million, but he's not, the Vatican or a pension fund endowment that is happy to wait 10 or 12 years. So if we can say we invested in this company in the seed and the A, so we doubled down in the A, now they're raising at such a big valuation. If I sell 5% of the company, I can return the money.
All the capital. Basically, you get your bases back, right?
Yeah. So, I mean, for simple math, someone puts in $1 million, I could probably return 250K from selling 5 or 10% of just one of our deals, leaving 90 to 95% to ride my winner, into the sunset.
If you do 4 of those, Andrew, I'm sorry, if you do 4 of those, you basically got your principal investment back and you're playing with the house money.
I think that's exactly right. Now, this idea is the same thing any 2-year out of college Merrill Lynch stockbroker would be doing. Whereas for a VC, so that's the genius, they're the Warren Buffetts. Yeah. And the VCs are like, hell no, I'm not going to shave one hair off of my fantastic net cash on cash multiple I'm making. And I'm not an IRR guy. I'm a cash on cash guy. I think that if you're making 10 to 15x cash on cash, we can afford to sacrifice a little bit of performance to give everybody their money back for 2 reasons. One, it lowers the risk when you return the money. Like if you get your money back, show me where the risk is now.
Yeah.
That's one. And now they can re-up in our next fund or use that money to pay for the twins to go to Stanford or whatever's happening in their life. There's no bad reason that you need money. So I like the idea of returning that money, but give them the choice. So what we're doing is we're saying you have 3 choices. Option 1, let me wire you the money back. And especially with friends or families that are new to venture, that are more comfortable where they can redeem out of a hedge fund, I want to see the money back with them and then show them for real what the remainder is worth. And it might double from here and they might get 8x back on top of their 1x. Option 2 is to say, look, this is what we know. I don't see how this company could have a Kevin Spacey moment and burn, but if it did, it would look like this or this or this. It looks like we have a perceived, hard to see a risk of it going down. And with 150 million being raised, or with a 50 million being raised, it's probably going to increase revenue. And on a discounted cash flow and comps of all the numbers, it's probably going to 2x in 1 year. So if I'm going to wire you 250K, do you want to wait a year so that'll be worth 500K, but no promise of liquidity 12 months from now?
Right.
So you're an adult, you make your decision.
Yeah.
And option two is recycle your exit consideration into the SPV.
Yeah.
And for that, we're not wiring money to the startup. Option three is recycle and double down. There's somebody who loves a 2X, put in 10 million, make 20 million back, knowing that if it drags on a few years, it might be 50 million back. And that gives the cash to buy the fund position. And we have a heightened level of disclosure with our LPs. And I would argue a heightened level of education that our LPs are often much smarter than we are. They've got more domain expertise. They own businesses. We're talking about this before making decisions as it's happening. The triangulation of information here is, I think, quite material. And so we're learning and they're learning. And as a group, we're adding more value to the startup, which we haven't really talked about is probably the most important thing for success, is whichever VC is really adding value to the startup the most should be getting the very, very best deals and having the highest performance.
So let's talk about that. How are you adding value to the founder startup as a VC?
Yeah, I would say at a high level, it's the network that we bring to the startup, the network we can wrap around the startup. So having a great network is pointless unless you animate the network. And these kind of, email memos and phone calls that are happening are important, but I actually like physical. Let's all get in someone's backyard and have a barbecue and have some drinks, and everybody introduce yourself the same way we did at the Founders Club. It's exactly that same ethos is carried over to this club mentality. So we'll have LPs from all over the world. We got a lot of people from Microsoft and Amazon and Google and Facebook and these big Apple and tech titans. We have a lot of Wall Street type people from New York. And then we have people from a lot of different countries. I love it when they fly in and we get at least one founder from every portfolio company, if not three, at these events, and everybody introduce themselves, and then you meet each other. And when we're sending out a summer report and a winter report with like detail on every company, that's a lot of information to get through. If we're sending you the report of saying, do you want cash? Do you want to recycle, or do you want to double down? They're going to read it because they're like, do I want to do this?
Now that you got to make a decision, right? Yeah. Right.
Yeah. Like you're talking like, do I want to bet money on this essentially? And if someone is saying, look, we're a fund of funds, we have a team of 7 people, we're in 25 funds, I can't look at every one of your deals, then just tell us and we'll kind of smart contract that for you. Yeah. Do you want to maximize IRR? Do you want to de-risk it and get your money back, get that fish onto the boat, into your refrigerator and into your stomach? Like, what do you want? And we won't bother you with the details. Right now, most of the people that are attracted to our network, our fund, want to be part of it, and they have something to bring to the table, or they want to learn, and we're each learning from each other. So I like to animate the network with real in-person events. And then we have what's called the limited partner in residence program. And I don't know, should I be talking about that now, Arthur? Or
yeah, talk about that. But 1 second, I have to share this so that you're going to probably remember in the news this week. Some entrepreneur had $1 billion valuation, coming into 6 months ago, bought a $33 million house in Florida. The valuation went down to 100. And now his house is really the money that he took off the table. Like, it doesn't matter whether it's encumbered or not, but it's the same example, right? I took some of my valuation money, bought a house, and it didn't get devalued. I might have to sell it now to live, but at least I've got an asset. It's kind of an interesting thing, right? It's sort of a stable value thing. Right.
There's a lot of animal instincts around secondaries. At the time that my first book came out, I'd really written it in maybe, way earlier than 2012, I think it came out. But the chapter 10 was the ladder to liquidity. And I was making the case culturally that it's okay for a founder to sell something. It's not such a negative signal that, oh, if Bill Gates is dumping Microsoft shares, he knows more than we do. Should be a run on the bank and completely crash the stock. But on the other hand, if you see a company that is pre-revenue that has some Theranos valuation and the founders are selling secondaries, that's a red flag. And, maybe nobody should be investing in that, but look, the way the real world works is no one is forcing an investor to buy stock in a primary issuance where it's, working capital to fund the company. And no one's forcing an investor of any kind to be buying shares off of the founder. That's common, ordinary founder stock. It's an adult world. I remember, not that long ago, we had funded Daily Harvest early, and I introduced the company to Peter and you at Lightspeed. Lightspeed has got a big fund. The company only wanted to raise 15 million, and they managed to get 47 million into the business. And the only, primary was the 15. So there's a lot of secondary selling, and that company is holding out for an IPO. They might have considered some of the de-SPACs that we introduced her to, but she's hanging out. So secondaries definitely are a complicated animal instinct thing. And I don't think it's the right thing in every case for the founder to get mad liquidity while the company is not really through the woods or on a clear path to what's going to happen next. And if that is happening, then it makes even more sense to me to be benefiting from that same valuation, return some capital to my LPs, and issue like real memo of these are all the thoughts and feelings we have about this situation. There's no two founders exactly the same, And
an LP liquidating is different than, a founder liquidating. And would you also argue that employee number 3 that is still only making $300,000 a year and needs to fund his kid's education, him doing a secondary to get some liquidity is different than the founder getting liquidity?
And this is where, if we speak too much about it, the SEC is going to want to know more. That when I was under a broker dealer and I was doing secondaries at sort of the birth of the secondary market, when I saw secondaries threatening my business as the head of the Founders Club, the Equity Exchange Fund.
Yeah.
And we were looking for as much inventory as possible to sell. And there's a thing called right of first refusal, which LPs get when they invest in our fund, that we typically would not invest in the startup unless we get information rights, a pro rata equity right to invest in future rounds, at a minimum maintaining our ownership percentage, and a right of first refusal, the ROFR. Yeah. So if you've got Peter Thiel invests in Facebook, he has the right of first refusal, information rights pro rata. Then Mark Zuckerberg says, I want to sell some of my founder stock in Facebook and cash in on this $2.5 billion valuation and take care of my mom. Fair enough, right? Yeah. And so an outside buyer agrees on a price and terms with Mark Zuckerberg to buy some of those shares. There's a shareholder agreement that says, is it 45 days or is it 90 days, that the preferred shareholders have a right to exercise their right of first refusal right. to buy the shares at that. It can't ping pong ball back and forth and say, I'll match that offer from that outside European buyer.
Yeah, you can't retrade it. It's just the same deal, right?
Either Peter Thiel exercises his ROFR and buys the shares, and the outside guy who spent all this time romancing Zuckerberg loses and walks away with nothing. Yeah. Or Peter Thiel says, wow, you have more conviction in this than I do. Have at it.
Yeah.
And he'll waive his right of first refusal. And I'm sure Peter Thiel's not the only, investor with preferred shareholder rights like a ROFR, Yeah. So there's this dynamic of getting ROFR'd or not getting ROFR'd, or being the one who does the ROFRing or being the guy who got ROFR'd.
Yeah.
And I like to think that we have real option, like Black-Scholes price option theory value, that we have a ROFR on everything. And if ever there's a secondary activity, I can email my LPs who we're pretty intimate with and say, hey, this is a he who wires first wins situation. I don't like short fuses, but we've been with this company for years. You've hopefully met her or him at our barbecues and stuff, and companies performing like this. Here's all the financials. I have all the information rights. if anybody wants to participate, we're going to spin up an SPV and we can invest up to 45 million, in this. And we might be even buying shares off of a VC, not necessarily.
Right.
We
Not
might,
just somebody who has the,
yeah.
like,
There might be
yeah,
some fund.
yeah.
There might be some fund who's got, all their AUM is this one deal, and they're struggling to raise their next fund. And if they 1x their fund, they're ready to sell half their position. Or maybe it's an individual. He says, I made 100 investments. I sell half my position in this one, and I've got money with no spousal approval required to get back in the game and make a bunch more investments at the early stage, or whatever the hell they want to do with their money. Yeah, so it's a very complicated thing with the secondary market. I guess you asked employee number 1, 2, and 3. When we wanted more inventory, we would encourage employee-wide liquidity pools. In fact, if you search for Mark Cuban and me, Andrew Romans, on YouTube, or Spotify, you'll see an amusing back and forth with me and Mark Cuban about this very topic. He was saying, "Oh, Andrew, the SEC is going to crack down on you hard for this," and I was like, "Well, right now, if you just follow the law, this is legal. A privately held company can issue an employee-wide liquidity program and say every single employee can sell up to 10% of their vested stock options, and let us know by this date." And it tends to happen at the beginning of the year. And so if you're trying to get into Twitter after February, when they were doing this, you're the guy who doesn't know what's going on. So you got to be ready for that, new 10% that comes out January 1st. And, everyone has to sanction this to happen. And so one of the benefits of working at Twitter, employee John Adams was the name of employee number 13 at Twitter. Really fun guy. And he's the last person allowed to sell shares on the secondary market with no encumbrance. By employee 14 onward, no one was authorized to sell anything without, not even encumber your shares. Like, I've met guys that are like, "I'll give you a loan."
Yeah.
All that stuff should, is technically illegal, but things that are illegal happen every day.
Yeah, but if it's a corporate sponsored liquidity pool.
Yeah, well, so that's legit, right? So that's where they said, we're going to have a corporate sanctioned, corporate run liquidity pool where I run a process and put together, I've got this much inventory of Twitter, who wants to buy shares in Twitter at this basic price per share. And the seller is the employee liquidity pool, which is set up like this, if you give a damn. Nobody really seemed to care, other than me, where the inventory was coming from, But Mark Cuban on CNBC, The Closing Bell, was saying, "Andrew, don't do that." And the reason Mark was saying that, which I can agree with spiritually, is that he's like, this whole artificial system is just dealing with our post-dot-com crash, Sarbanes-Oxley, live in blood in the streets. Why don't we be like the Chinese and allow our companies to IPO when they're ready? And actually IPO companies again, get Goldman and Morgan and JP Morgan out of the way, and let's start IPOing companies that the world wants to own stock in, and give them a currency and cash to do M&A deals and all that. We're cutting our feet off on our ability of our non-robust capital markets, where the Chinese are very robust. What's happening over there with Shanghai, Shenzhen, Hong Kong Stock Exchange, like the TMX in Toronto, or the ASX in Australia, or AIM in London.
Yeah, but that's two different things. The argument, let's let things go public, or a function of market influences. Like, can we go public, and do we get a big enough price? And if not, we're not going to go public. And so,
and live with running a publicly traded company, or the VCs having markdowns. Most people don't know about structuring. That a lot of secondaries in the late pre-IPO stuff are highly structured. And what that means is, like, let's say you, Arthur, are the founder, or you're the VC who wants to sell a little bit of XL12, which was in Facebook before the IPO. I say, look, let's do this. I'm willing to give you a $70 billion valuation, even though I think it's 50. If I make, after I make a 2x on my on my investment, I'll then let you get 70x and I get 30x, 30%.
30% of that.
Yeah,
Yeah.
you get 70% and 30% of the next bump.
Yeah.
And then after you've gotten, so you got your
50,
cake
50,
and eat
yeah,
it too.
yeah.
So you sold me your shares and you still get to eat your cake. And then it goes back and forth, and it's this highly structured, which means the 70 million pre was never one to generally understand to be the value of the company. And even if it goes public at 50, this guy's making money.
Yeah.
Before regardless, so those structured deals kind of confused the civilian that was not in the room really seeing what was happening. Yeah. And I think that, look, if you remember the movie Wall Street, Michael Douglas's character, Gordon Gekko, he's working with Charlie Sheen to get insider trading information. And then they buy Blue Star Airline or whatever the hell that thing was. And then the press release comes out that the sales have doubled or there's a merger. And then he flips because it was publicly traded. He flipped out minutes, days, weeks after his private information came into his possession. And of course, that's naughty. That's illegal, and he goes to prison.
Yeah.
In the private markets, it's not illegal to have information rights. In fact, it's legal and formalized. And imagine you invest in 25 companies. You have information rights on all of them. You have a pro rata equity right to invest in their next round. You got a ROFR to get more money on these assets if you want them. And there's trading activity. And you have a great network of people that are helping them. You're at the barbecues. You're helping your companies raise money. They like you. And you can double down on your winners. And because it's privately traded, this is legal and encouraged. And you get a lifetime achievement award for doing it.
Yeah.
But there is a certain strange level that companies are not going public like they used to. Like I remember Lyft. I remember seeing Carl Icahn. Someone told me, I met a guy in Austin, told me that he worked for Carl Icahn. I said, how much did he put into it? That was a 600 million round. He said he put in 100 million clean and he made like 100x on it or something crazy. But I remember seeing if Carl Icahn and Fidelity were leading a private, round into Lyft, these are IPO people. And so there's been crossover from hedge funds and Tiger Globals to invest in growth stage VC privately held stuff. And they might want to be extra careful on their end since most of their money's in the public markets. But, Mark Cuban's not wrong when he says you got to be careful of this blending line of.
Also, if you piss somebody off, then they start spending endless amounts of money to make you defend yourself, and that is a slog. Let's talk a little bit about the entrepreneur in residence, founder in residence. What's the right
so it's the LPIR. So part of our attempt to interact with our LPs more, which we see as a positive thing. I actually wrote a book, Masters of Corporate Venture Capital, and Japanese corporates were rotating executives from Japan to the US to be with the investing team.
It's like the hero's journey, right?
That's right. And everybody honestly hates the corporate guy until he goes back to the corporate. Now they love him because when they meet a startup saying, oh, I can some fintech for matching of your 401k or something, they would send that to the corporate and nobody wants to touch it. I'm not going to take a risk, be the guinea pig on that. Whereas the guy that's been sent back, it's like, I'm now brainwashed to be like Silicon Valley. Show me the deck and I'll introduce it to the right business unit. So innovation is actually getting into the corporate, which was the goal. They don't even care about making a return. They just want to be a beneficiary of technological change, not a victim of it. If we're going to automate all accounting, let's be the first to do it, not the last to do it. So we thought, well, why don't we do this with family offices? Why don't we say, we'll take your son or daughter, niece or nephew, or member of your team, and we'll give them 7 BC venture capital business cards, have them work with us for a year or 2 years. And I like it if they stay 2 years, so the investment we're making and training them, we're getting a dividend on that. Like, I don't want an intern for a week.
Yeah.
And then they get, venture capital on their LinkedIn resume, CV, and then they rotate back to the family. And now all this stuff we're doing, do you want distribution? Do you want to recycle? Do you want to double down? We now know everything about your conglomerate in Asia or Boston or whatever.
Yeah.
And it's like a lifetime relationship. So the limited partner in residence program, LPIR program, is important to us. And I think it's a big differentiator that when a startup is pitching us and they meet one of our LPIRs, that LPIR maybe knows the business better than we do because they run a business that would be the customer of that. And it's a whole different vibe with the founder, making it better for all parties. The other thing is that not everyone can take a year off or even 6 months off. And often it's the matriarch patriarch that wants to do the LPIR program. So what we say there is just do a shadow week. We're going to be in Seattle for a week. We're having an event.
Yeah,
we're
come
going to have
hang
7
out.
VCs.
Yeah.
Yeah, just fly in Monday and fly out Friday and do a shadow week with us. And so we tell them, like, we're going to be in LA, we're going to be in New York, we're going to be in Miami, come and join us. Or there's a specific deal that's very relevant to your business. Do you want to join the Zoom and listen to the founder pitch? And you ask smart questions instead of me asking dumb questions. So Zoom is creating a little bit of an opportunity there to do that.
Yeah, I think that's super productive. Not only is it good for you, you get smart people helping you do things that you need to do day to day. They get baptism by fire, and all of a sudden they get a schooling that would take them, otherwise 3 or 4 or 5 years at a job that they hated. Right now,
and don't forget the founder. So, the LPs are like our shareholders and the founders are kind of our customers. Yeah. When a founder is raising a round and they're trying to get 4 meetings a day for a couple of weeks, they're in back-to-back meetings with other VCs where it's like a Stanford MBA with no experience, interrupting their answer with another question. And then they come to us and it's like a Founders Club introduction, like, introduce yourselves, guys. It's like having Mick Jagger and Keith Richards behind you.
Yeah, right.
And the founder will walk out saying, there was like a real business person operator in that meeting. Wow.
Yeah. Cool. Look, this has been super great. It's in deference to our audience. We've got to wrap things up. I really, really appreciate your insights. And to the audience, Andrew and I have had an opportunity to talk a whole bunch about a lot of other stuff that is as interesting as this. And so it coming up in a week or so, we'll alert everybody there's going to be an opportunity to talk about the fund in more detail. And so you're going to get alerted to that. And we'll make sure that Andrew has all your information, and please feel free to communicate with him directly. And also, just to be clear, the next webinar is based on a pitch, meaning, Andrew wants to talk to potential LPs. Doesn't mean you can't show up if you're not, but if there's others in your community that would be interested in hearing the nuances about the fund and potentially be an LP, please share the invitation when you get it from us. So, Andrew, that was awesome. Super.
Well, Arthur, thanks so much, buddy, for the opportunity. Love talking about this stuff. I think, net is, there's a lot of reasons why investing right now expects to make a bigger cash on cash return than when, just investing last summer of 2021, where the market was out of whack. And we're thankful to see things kind of return to sanity.
Yeah.
A little
got
bit.
A little frothy.
It's better for us.
Yeah. Got a little frothy probably. So
yeah.
Super.
All right.
Thank you, Andrew. Really appreciate it. Thank you, everybody. And as I always say, thank you for spending with us the only thing you can't make more of, and that's your time. Thanks. Till next time. Thanks, Andrew.
Bye for now.